SUERF, the European Money and Finance Forum, bringing together policymakers, finance, and academia.
Welcome to this BIS-ECB-SUERF e-lecture on monetary policy frameworks, recent developments and outlook, an international comparative view. Central banking was a boring business before the GFC and what followed. It certainly no longer is. The environment in which central banks operate nowadays changes fast, and it is often characterized by extreme and unprecedented developments. Crises and massive domestic and global supply and demand shocks play havoc with output, potential output, and employment, and may cause sudden or persistent downward or upward pressures on prices and inflation. In such an environment, to stabilize expectations and create trust in money, it is central that Parliament, the government, financial markets, and the public at large understand what central banks are doing and why. Major central banks nowadays formulate explicit monetary policy strategies to enhance effectiveness, transparency, and accountability. In the light of a fast-changing economic environment, strategies are regularly reviewed based on comprehensive research and stock-taking exercises. The ECB published the outcome of its latest monetary policy strategy review on 30th of June 2025. And the Federal Reserve published the outcome of its 2025 monetary policy framework review on 22nd August 2025. We will hear key insights from these reviews today and discuss forthcoming challenges for central bank strategies with international policymakers. Before we enter into the presentations and panel discussion, let me say a big thank you to the members of the organizing committee for this event. Fiorella De Fiore, Research Advisor in the Monetary and Economic Department of the BIS, and Fabian Eser, Counsel to the Executive Board of the ECB. A big thank you to both of you. Without further ado, Fiorella, over to you.
Thank you, Ernest. And let me thank in particular SUERF for co-organizing this exciting event. We have organized it around two sessions. In the first one, we have asked three leading experts from the ECB and the Federal Reserve Board to provide a bird's eye view of the focus points of these monetary policy reviews and to describe the main findings of the underlying analytical work. In the second session, four panelists from different central banks that recently engaged with similar reviews will broaden the discussion and offer an international comparative perspective. So let me now introduce the speakers of this first session. From the ECB, we have Christoph Kamps, Deputy Director General in the Directorate Monetary Policy, and Christian Nickel, Deputy Director in the Directorate Economics. And from the Federal Reserve Board, we have Trevor Reeve, Director of the Division of Monetary Affairs. So let me now turn to Christian and Christoph for their presentations of the analytical work conducted by the Eurosystem in the context of the recent review.
Thank you very much, Fiorella, for this very nice introduction, and also to you, Ernest. Christoph and I are very happy to be here and present our work. I will introduce the work of Workstream 1, a strategic view on the economic and inflation environment in the euro area, by saying first about a few words about the process. From summer 2024 to summer 2025, I led the work of more than 100 Eurosystem contributors working together on a strategic view on the economic and inflation environment in the euro area, and the two task forces with 2 task forces and 5 focus groups. And this intense collaboration actually led to a strong alignment across the euro system and the national central banks in the euro area, and that has then formed the basis for the work undertaken in Workstream 2 on monetary policy that Christoph will present. The report we produced and published as an ECB working paper or occasional paper covers 3 main areas: lessons from the inflation developments since the last strategy review, key secular drivers shaping the outlook, and then implications for our analytical toolkit and forecasting. And my presentation today will highlight the most policy relevant insights from this report. The first few slides of my presentation will cover the more backward-looking part. And since the last strategy review, the euro area inflation was driven by a large series of big shocks. They were mainly energy, and this is what you see on the left-hand side, and both oil and gas have played key roles. We also saw reopening effects and major supply bottlenecks after the pandemic, which added to price pressures. And you see these bottlenecks in the middle. And food prices reacted strongly, as food production is also highly energy intensive. Importantly, it was only in the later phase that these large energy and food price increases fed through to core inflation. And this is what you then also see on the right-hand side, where you see that core inflation really then kind of picked up later on. One question that we asked ourselves in this phase of high inflation was, of course, what is the nature of inflation? And that was then also crucial to calibrate the appropriate monetary response during the inflation surge. And here it was in particular important to know whether this is a supply or more a demand-driven shock that we were facing. Quantifying the relative importance of demand versus supply factors is challenging given the multitude of shocks hitting at the same time. So here the workstream team constructed a meta-analysis, a chart pooling together evidence from the available models across the ECB and NCBs. So in other words, what we show here is in total 6 different models that we run regularly in, let's say, the European system of central banks. They cover both structural VARs and DSGEs, so various setups. And when you look at these 6 different models, this model evidence actually suggests that on average, the contribution assigned to supply factors, both global and domestic in nature, played a more prominent role in the latest inflation surge compared to global and domestic demand factors. And this held in particular in the initial phase of the inflation spike. Then later on, also demand factors also mattered, but apparently less so. And this is what you see really on the right-hand side, where this curve is much, let's say, flatter and only kicks in a little bit later. And this finding then has also been taken up by Workstream 2 to actually also look at the correct or the right response from monetary policy. One of the interesting findings and realities that we have to face, that we are grappling really with a lot of nonlinearities. And this has become also more evident since the last strategy review. And here we show 2 examples of our analysis. On the left-hand side, you see that the frequency of price changes, and these large shocks and high inflation increased this frequency of price adjustment, and that you see in this little area between 2022-23. So during this phase of high inflation, also suppliers adjusted their prices more frequently and put them up. And that also amplified actually the pass-through of shocks. And it also led to a temporary small steepening of the Phillips curve during this phase. By 2024, the price setting frequency has normalized and reduced this effect. On the right-hand side, you see the response of core inflation to energy price increases and decreases. And positive energy shocks have had a much stronger pass-through, this is this red line, to core inflation than negative shocks. And this highlights also the importance of nonlinearities. At the same time, what was going on the wage side was quite different. So while we've seen this increase in the price setting frequency by firms, wage setting has remained stable and staggered. While firms raised prices more frequently, microdata from the wage tracker show little change in wage contract renegotiation frequency or duration, and that is shown in the left-hand side and in the middle charts. Now, looking ahead, structural trends like aging and upskilling could make productivity growth more cyclical, as employment becomes less sensitive to downturns. And that is a bit shown also on the right or far right-hand side. In recent years showed that how short-time work streams, labor shortages, and an aging workforce softened employment swings but lowered productivity growth, amplifying unit labor cost pressures on prices. Firms were able to absorb weaker productivity thanks to higher margins and lower real wages, but going forward, the cyclical nature of productivity could become an even bigger factor for price dynamics. And now we are trying to kind of put together these two pictures. On the one hand, you had this higher frequency of price setting, and on the other hand, you have this staggered wage setting approach that did not change much over the last, 5 to 10 years. And this kind of unusual behavior also can then explain a bit the unusual behavior of profits and wages during the inflation surge and disinflation. And this pattern could also repeat in future large supply shocks. Initially, rising profits were a key driver of domestic price pressures as firms increased the frequency of price changes. More recently, however, they helped absorb rising wage costs as wage growth caught up with past inflation amid a tight and resilient labor market. These developments are also reflected at with the three columns on the right, and in particular with regard to the flip-flopping of these yellow bars, which represent profits. So in this first phase, you had indeed this kind of idea of increased profits, but then when it came to higher wages, these profits actually did what profits normally do, namely buffering this pass-through. Wages contributed less than usually to the build-up phase and only reached historical averages during the disinflation phase when profits resumed their buffering role. Productivity remained below average throughout, adding to price pressures. These patterns likely reflect the unique context of the pandemic and energy crisis rather than structural changes. Firms could pass on higher costs without cutting profits as demand stayed strong, while wage adjustments were delayed by bargaining rigidities, job retention schemes, and energy-related transfers. During this phase of high inflation and large shocks, the key question was whether wages would spiral and fuel even further inflation. With hindsight, we can say this did not happen. And the key factor for this was that inflation expectations remained well anchored despite the post-pandemic inflation surge, and longer-term inflation expectations have remained anchored at 2%. And in our analysis, we then also show that the monetary policy response was crucial in bringing inflation back towards targets and reinforcing the credibility and preventing wage price spirals. And this was then also analyzed in workstream 2, and Christoph will more on that later on. When we look at the right-hand side, the 2021 strategy review had found that trend inflation had declined, highlighting the role of structural drivers beyond the business cycle. Globalization, digitalization, and aging were seen as dampening forces contributing to low trend inflation under the pre-2021 asymmetric target. This decline raised concerns about the perceived inflation target and the ECB's ability to meet it. More recent estimates, however, suggest that trend inflation has increased somewhat, and this is this solid yellow line, though uncertainty remains and estimates are subject to revisions, and that is also a bit seen with this yellow dotted lines that are relatively far away from this other solid yellow line. The shift points to better anchoring of inflation expectations at the ECB's symmetric 2% target and possibly to evolving structural forces, including geopolitical tensions. Again, this strategy review looked at structural factors, and what we actually note is that several structural factors have shifted notably. First, geopolitical tensions and the possible fragmentation of global production networks stands out as a major change. Some existing trends like climate change and digitalization, including generative AI, have accelerated, though AI's impact remains uncertain. Demographic trends continue broadly as expected, though immigration prospects remain unclear. Unlike in the past MPSR, these secular forces no longer point clearly towards disinflation, but now pull in different directions. And global fragmentation, and this is what we show at the right-hand side, in particular, risks adding inflationary pressures by disrupting supply chains and raising input costs, with studies pointing to negative GDP effects, but upward pressure on inflation. Now, it's important to be clear that we did not, focus so much on whatever Trump tariffs was. That came actually only relatively late in our process. But to kind of make more broad analysis on what, global fragmentation means. But the Trump tariffs, etc., is of course part, for example, of our regular conjunctural analysis that we do in our forecasts, etc. So that it is not done here doesn't mean that we don't do it. In the next slide, I wanted to show a bit how uncertainty actually affects inflation volatility. And here I wanted to simply make the point that while this, combination of shocks that we had, such as the pandemic and the energy crisis, were rather unusual, we now face a world of potentially more frequent and larger shocks. For example, from geopolitical tensions, climate change, or trade policy shifts like the recently announced tariffs. But if some of these tariffs are later paused or withdrawn, the uncertainty they create can already increase inflation volatility. And more broadly, the post-pandemic environment is marked by much higher uncertainty, with geopolitics as a key example. And this is what is shown here, that higher uncertainty actually also increases inflation volatility across, the different items or different parts of HICP. We also spent quite a bit of time, given this new environment, looking at our toolbox and what has happened basically since the last strategy and review, and whether we, our toolbox is still fit for purpose. And what we do in the ECB is we have, on the one hand, sensitivity analyses where we look at, how different oil prices, interest rates, etc., would affect our forecasts. We also have a survey, the quantitative risk assessment, that, among staff members about the different effects of risks. And we also have scenario analysis, where we have, more trying to build a narrative around a certain what-if scenario. And what we show on the right-hand side, that this building of scenarios is actually quite beneficial and or can help us a lot. And here, in particular, we show the Ukraine scenario that we designed already back in March 2022. This is this red dot. And this red dot later on turned out to be much closer to what the realized inflation was, the yellow line, than our own forecast. So having a good scenario design can indeed help to inform policymakers. We spend also quite a good part on designing, how should scenario analyses been done in the future. So not every scenario might qualify as quote unquote a good or an appropriate scenario. There we say on the right hand side, a scenario is relevant and important if it has a high probability to materialize, if it has a big impact, and also there is a monetary policy implication that justifies undertaking this scenario. With this, I would give the floor to Christoph.
Thank you very much to Ernest and Fiorella for having me. Just to say that the report 2 on monetary policy, tools, strategy and communication was also an immense team effort throughout the Eurosystem. We had more than 200 contributors, and I had the pleasure to co-lead that work stream with Mathieu Bussière from Banque de France and two colleagues, Ernest and Fiorella, know very well respectively, Birgit Nissner from the Austrian National Bank, and Oreste Tristani from the ECB. So one of the things that, if you want, the Governing Council said already from the very start of the exercise was to maintain the symmetric 2% medium-term inflation target that had been agreed in 21 after extensive analysis and discussion. And there was a joint feeling also when the 25 exercise started that this clarity in the target and the enhanced clarity compared to the previous definition had helped a lot, not only getting out of the lower bound, but also managing the high inflation period and bringing inflation back to target while maintaining inflation expectations anchored. And so that part was really not up for debate. One of the things we've done in the report, in the communications chapter, is to see also whether this enhanced clarity of the target actually had an impact on consumers and firms. And so here we used our surveys and in December 24 ran an exercise, a randomized controlled trial where we gave different information to different groups of people. And we can indeed see, and that's what the left-hand chart shows, that there is an impact on the ECB's credibility in maintaining price stability. And so certainly also in that respect, we need to do further efforts, but we can see that this enhanced clarity and also simplicity of the target has clearly helped. And in the report, you will find a nice box showing a lot of evidence on that. Another thing we looked at, even though it was clear that the medium-term orientation as such was also not up for debate, was really to fill it with more life compared to 2021, where there was very little discussion on the medium-term orientation and in particular, the concept of looking through. And what we have done in the current report is really to dig very deep into different channels that affect the ability or not to look through temporary shocks. We could see that if you have a series of temporary shocks, there is of course always a risk that inflation becomes entrenched. And so the infographic on the left-hand side basically is a visual summary of what we've done in the report, where we have also, the Eurosystem staff have introduced a lot of new models that look into individual channels and really explore to what extent this speaks towards looking through or basically imposes limits on looking through. And one of the factors, or two of the factors that have been especially pronounced in the latest episode were, of course, risks of upside inflation disanchoring. We have a number of research pieces that show that the determined monetary policy action was actually essential to counter risks to upside disanchoring. And also the other one was the temporary steepening in the Phillips curve that also Christiane discussed already. But we have had other episodes where actually the context would have spoken in favor of looking through energy supply shocks. And clearly we could see that after the GFC when we had oil price spikes, but at the same time we could see financial frictions and hysteresis effects kicking in. And so the general conclusion, which basically confirms what we had already in 2021, that whether you can look through or not depends really on the origin, magnitude, and persistence of the shocks and the inflation deviation that we are faced with. But if there is one added emphasis in the statement here, it's really that maintaining anchored inflation expectations is really the key. What you see, by the way, on the slides in the blue boxes is the new statement that was agreed by the Council on the 30th of June with some highlights of important elements. And that's basically a guiding principle throughout the slides. One of the things we have revisited, you will remember that in 2021, the strategy called for especially forceful or persistent action close to the lower bound. So one of the things we've done is to revisit to what extent the lower bound risks is still material. And the answer to that is yes. The left-hand side graph basically shows you the range of estimates that we had in 2021. And then there is an update, so the dots and triangles, etc., in the in the graphic basically show you the latest estimates based on new data and an update of the model. And by and large, we confirm that the order of magnitude of lower bound risks is similar to 2021, even if R star may have increased somewhat. But the basic conclusion is that R star remains low in the euro area, and certainly much lower than in 2003. So the purple dot that you see in the lower left panel of the chart, that's basically the ELB frequency as estimated in 2003. And you can see that it's an order of magnitude smaller than it was in 21 and is now. And so in that sense, we confirm the need for forceful or persistent policy action close to the lower bound, and also that in the event of significant disinflationary shocks, the lower bound certainly needs to be taken into account. But that's just one side of the medal. What we of course also looked at deeply is to what extent there is a similar case for forceful or persistent policy action to the upside. And the basic conclusion is that yes, in a sense, what we could see in the pattern of tightening that we observed in the euro area, but maybe more broadly, is that there were two phases in that tightening. The first one was very forceful. It was getting out of negative rates, going through, if you want, what one could call the neutral territory, and going really deep into restrictive territory, and doing that fast. But at some point, it was clear that the cost of further tightening could outweigh the benefits, and that's when at the ECB, the focus shifted to the degree of tightening being made more persistent. And you can do that, of course, by varying the length of the holding period. In our case, that was from September 23 to June 2024. And so it was really the commitment there to say we can keep rates at a deeply restrictive level for as long as necessary to bring inflation back to target. And basically exercises we did, and we report also in our study, is different tactics, whether you want to hike further once you're already deeply into restrictive territory, or whether you want to keep rates at that level. And so on the left-hand side, you can see different interest rate path configurations that, according to our models, would bring inflation back to target in 2025, as viewed from September 2023, when we actually started the tactic that has more to do with persistent. And so what we do here is that, yes, forcefulness and persistence matter also to the upside. And in the statement, we also point to nonlinearities that are important to take into account, because, of course, you don't want to have self-feeding dynamics whereby, high inflation might become entrenched. Closely related to that is also how to account for risk and uncertainty in policy settings. So basically the table on the left-hand side, which I will not explain for lack of time, but you can find details in the report, is a risk management exercise where we look at different scenarios and the baseline, and we asked the stylized rate paths that you saw on the previous slide, how would they perform outside the baseline? So for example, if we have shocks that increase the persistence of high inflation, or on the other hand, if actually policy has more traction than we believe, and of course that will have implications for which tactic is preferable. At the same time, what we also looked at is whether, there is a kind of silver bullet, whether you can say you can adjust your reaction function in a mechanical way. Whenever you have uncertainty, you will either be more aggressive or less aggressive. But basically what we discuss in the report is that there is no simple prescription like that. At the end of the day, whether you will have policy attenuation or increased aggressiveness will always depend on the context. And so in that sense, also the way to account for risk and uncertainty, that's the phrasing the Council also uses in its overview note, is systematic but context specific. But what is very clear is that there are times when the baseline is simply not sufficient for policy setting, and risks and uncertainty always need to be taken into account. And clearly, if the risks are tilted clearly to one side, that will have implications for policy making. One of the things we also did is, and we had done a lot already in 21, is to revisit the monetary policy toolkit, whether there are new lessons learned. One side of that is effectiveness. The other side is, if you want, the cost of what we used to call non-standard measures. Overall, the conclusion is that the measures have been effective in countering disinflationary risks or risks to transmission, and so they all remain part of the toolkit. The left-hand side is basically an update of a meta study we did in 21, which confirms that in terms of effectiveness, these measures help. And at the same time, one of the things we really looked at is, while at the ELB, especially if the ELB has been very persistent, it may be useful to combine instruments and basically build one commitment on another one to really be sure that one doesn't react to false positives. At the same time, of course, there's a price to pay, and it's reduced policy flexibility, and which can be costly if the inflation environment abruptly changes, and that needs to be taken into account also. So as said, the other side of the model are trade-offs, especially the trade-off between commitment and flexibility. And the other one is side effects on the economy as you use the non-standard measures for a long time or with increasing intensity. What we find overall by updating also the evidence in 21 is that the side effects overall have remained contained. There were some fears also in the profession that if there was a significant policy turnaround, then we would see cracks in the economy, in the financial sector, and maybe also in households and non-financial corporations. We haven't seen that in the latest episode. One other topic that has received quite some attention is central bank losses. We have discussed that in depth, and also in the report you will find some analysis. But what we can conclude with confidence is that the losses experienced in the current episode have not and will not threaten the Eurosystem ability to maintain price stability. At the same time, there is a kind of design principle that is embedded also in the new strategy, is to say, if you have two alternative instrument designs that are equally effective in terms of price stability, then of course choose the one that's more efficient, and that can also be along the central bank income dimension. One key principle that is in the new statement also is basically that the design of instruments should enable the ECB to be agile in case there is a significant change in environment. We also revisited monetary policy communication. The focus here this time was especially also to what extent we were able to reduce uncertainty via communication. We all know that risk and uncertainty and dealing with that is inherently complex, and so we needed to find a simple way to convey what we would use as auxiliary information to manage that complexity. And as you will recall, in March 23, we introduced a reaction function, a stylized one, that explained what additional criteria are important at times when the baseline is subject to significant uncertainty, and that was underlying inflation and the strength of transmission. And overall, we think that that has reduced also interest rate volatility, has helped to manage expectations. The chart on the left-hand side is one from the report that shows that after 23, the monetary policy shocks became smaller in magnitude. One other thing we have done is that since the conclusion of the review, we emphasize risks more prominently in our monetary policy statement. And in June 23, for example, there was also a communication about the scenarios analyzed at a time when it was unclear how the trade negotiations would go. And again, this is an element that is sometimes used when we think it's helpful for communication, but it's not something where we commit round after round to have at each meeting a detailed description of that. So let me stop here. Thank you very much.
Thank you, Christian and Christoph. This was a very rich presentation covering both the economic and inflation environment as well as the monetary policy strategy. So let me now turn to Trevor Reeve, who will give us an overview of the analytical work at the Fed.
Thank you for inviting me to participate today. It's an honor to be here. Let me offer the usual disclaimer that the views I'm going to offer here today are solely my own and may not necessarily reflect those of the Federal Open Market Committee or anyone else at the Federal Reserve. Okay, let me first begin with an overview of the framework review that we conducted over the past year or so. One starting point for this is really the 2020 review, which was the first public review of the Fed's strategy, tools, and communication practices that had been conducted. That was a key initiative of Chair Powell when he became chair, and was viewed as a very useful exercise, as I think this group well understands, for ensuring that the monetary policy framework is fit for purpose, given the economic environment that we are operating in. And it's also very important as a means of engaging with the public in terms of improving understanding of the central bank and building a sense of accountability and transparency, which of course is very important for the public's trust in the institution. This year's review was very much focused on the changes that were introduced to the framework statement in the 2020 review. And so much of what I talk about for the remainder of this session will very much be geared toward that. So let me begin with an overview of the elements of the review. And this very much patterned the 2020 review as well, as the three key elements from that review seem to work out very well. We basically mirrored those in the review this year. Those three elements are listed here. First was Fed Listens events around the country, and I'll have more to say about each of these three things on subsequent slides. Second was a flagship research conference that brought together academics and researchers to weigh in on these topics. And third was a series of FOMC discussions supported by staff analytical work. And in most of what I talk about this morning, I will be reviewing at a very, very high level, much higher than Christophe and Christiane, the focus of each of those work streams and basic results. The key outcome of the review was the revised statement on longer run goals and monetary policy strategy, which was released on August 22nd. Chair Powell explained the revisions to that document in his speech at the Jackson Hole Symposium. And I will get into some of those changes in our next session, and we can go through those at that time as well. One thing to note is that all the materials that were prepared for the review are available on the Federal Reserve Board's public website. That includes links to all the Fed Listens events and a summary report, all the materials for the research conference, including videos, and all of the staff analytic work that went to the FOMC. Okay, let me just say a couple words about the Fed Listens events. These, of course, were initially created in the 2019-2020 review, and were very helpful in hearing from a much wider range of constituents across the country and how the Fed's conduct of monetary policy in the support of its dual mandate goals of maximum employment and price stability were affecting Americans throughout the economy. 10 events were held this year at reserve banks. These happened between March and June of this year. Videos and summaries are available on the website, along, as I said, with the summary report. And as noted, right, these events really engaged with a very wide range of individuals and groups. There were representatives of small and large businesses across a variety of sectors of the economy, employee groups and labor unions, state and local governments, schools and community colleges, workforce development organizations, housing groups, and financial institutions. And there was a lot of rich discussion and a lot of things that we heard through those engagements. I've listed a few broad takeaways here. Perhaps not surprising, one of the things we heard loud and clear is that people do not like inflation. That's kind of an obvious lesson, but it is striking that in the Fed Listens events that occurred in 2019, inflation barely registered in the discussions. Of course, that was an environment of very low and stable inflation, and it certainly was not top of mind in people's decision making. That is, of course, is a good thing and what we're trying to get back to. But this time around, as you can imagine, inflation was seen as a first order problem. And even with a solid and stable labor market, the high cost of essentials was really weighing heavily on people's daily economic experiences and straining household balance sheets and so forth. Another lesson is that the sort of dislocations that occurred in the labor market following the pandemic were quite severe. Businesses had tremendous difficulty in attracting, training, and retaining employees, and they've had to adapt their practices to improve on those metrics, and those changes have certainly persisted. Another key theme was that economic uncertainty was looming very large and affecting decision-making for businesses. This economic uncertainty was primarily, at the time these events were conducted, was primarily focused on broader changes in government policies in the United States, less so monetary policy. And that relates kind of to this next point, that for many, the most immediate economic concerns that people were concerned with were not within the remit of the Federal Reserve. They were broader economic issues that more lie in the domain of elected officials and not the central bank. And then finally, some did note that Fed communications for general audiences could be improved. We know this, it's a challenge, of course, and we're always trying to do better on that score, but it's good to hear that people would welcome that. Okay, the second element of the review was our research conference. It was the second Tomas Lavak Research Conference, which we held here in Washington in May of this year. The event was live streamed, and video recordings for all the papers and presentations are available on the board's website. We had 6 paper presentations with prominent academics and researchers, as well as a policymaker panel discussion. Some overlap with today's panel. And key topics, included the 2 sides of the dual mandate, the labor market and maximum employment, inflation dynamics and inflation expectations, as well as monetary policy strategies, tools, and communications. And then, of course, the third key element of the review was the FOMC discussions. For the first 5 meetings of this year, the committee devoted time during its meetings for these discussions. The January meeting reviewed the previous review, the 2019-2020 review, as well as the experiences of some foreign central banks with framework reviews. That was very much meant as an opportunity to get everyone on the same page with the history of the review and of the committee's statement on longer run goals and monetary policy strategy. So everyone had sort of a common information set to go forward with. In March, they discussed the maximum employment side of the mandate. In May, inflation. In June, a discussion of uncertainty and risks, both in terms of the implications for the design and conduct of policy, but also for potential monetary policy communications. And in that vein, issues that we've heard about from our ECB colleagues related to scenarios and risks and uncertainty were featured. And then in July, the committee had its discussion of the actual revisions to the statement on longer run goals and monetary policy strategy, or the consensus statement, as we call it, since it is supported by everyone on the committee. And again, I will come back to those particular changes in our next session. All right, let me give a very high-level overview of the analytic work. There were 10 papers produced for the review. This is a list of the titles. I'm going to go through most of them very briefly on subsequent slides to give you a flavor of what they are about. There is a roadmap note that gives a similar brief overview of all of these papers. I believe that was shared with the group prior to this webinar. And that roadmap note was authored by the steering committee that oversaw all of these work streams. That steering committee consisted of me, as well as my colleague here at the board, Stacy Tevlin, the Director of Research and Statistics, Anna Paulson, who at the time was the Director of Research at the Federal Reserve Bank of Chicago, now the President of the Federal Reserve Bank of Philadelphia, and Sylvain Leduc, the Research Director at the San Francisco Fed. The first 2, I will not go through the first 2 memos, because these really were the background about the previous review that was provided to the committee, again, to level set everyone. Just to note, a majority of the current members of the FOMC were not in their positions at the time of the last review. So this was an effort to, again, to get everyone up to speed with what had happened and why. So let me now go through numbers 3 through 10, again, very high level, and then we can turn it over to Q&A. All right. So there are two memos written on the maximum employment side of the mandate. This one, assessing maximum employment, reviewed key indicators for assessing labor market conditions and the level of maximum employment. Very topical for what is going on now in the US economy as well, given lots of interesting cross currents in the labor market data. It examined concepts of maximum employment and focused on the highest sustainable level of employment while maintaining price stability. And you'll see that echoed in some of the language in the revised consensus statement that we'll come to later. Key takeaways: the unemployment rate remains a key cyclical indicator of the labor market. It is well understood by the public, time-tested, highly correlated with other indicators, and importantly, its large cyclical movements relative to a trend do provide clear signals of recession. Of course, no single indicator captures the richness of the labor market. Other indicators are critical as well. Job vacancies and the vacancy to unemployment rate, of course, is something that got a lot of attention through the pandemic period. There's a discussion of that in the memo as well. And then, of course, maybe the broadest measure of employment is the employment to population ratio, and differences in the cyclical behavior, say, of the participation rate versus the unemployment rate as one goes through the business cycle. The second labor market paper then addressed the implications of the labor market for monetary policy strategy. And here, the paper really focused on investigating this use of employment shortfalls, or of mitigating employment shortfalls, rather than two-sided deviations from estimates of maximum employment. That was a new feature of the 2020 consensus statement, and this paper really analyzed that in a framework of simple policy rules as to what it really means to conduct that policy in a manner in which, in a very over-stylized manner, that you only respond to employment shortfalls from maximum employment in the rule, not when employment is above its estimate of its maximum level. Arguably, that is not really what the FOMC meant by incorporating that word, shortfalls, in the 2020 statement. And when we talk later, I'll talk about how they've tried to clarify that in the new statement. The key takeaways are, as you might expect, a shortfall strategy generates modestly higher inflationary pressures than strategies that respond in a symmetric manner. However, the differences in average employment outcomes are actually pretty small. So that could, of course, be useful if you do want to achieve higher average inflation, because that mitigates ELB risk. But it can also lead to greater inflation risk in the presence of nonlinearities, in which you may be exposing the economy more to rapid increases in inflation through the conduct of policy. And one takeaway, of course, is the need to respond forcefully to inflationary pressures, particularly if they're affecting longer-term expectations. The next four memos concerned inflation. And the first one here is a retrospective on the Federal Reserve Board staff's inflation forecast errors since 2019. So this really gets into the real-time forecast that the board staff, that's not the FOMC's forecast, but the forecast from the Federal Reserve Board as contained in the Teal book. It gets into the details of the evolution of those forecasts, how the staff was thinking about modeling inflation through that period, the different factors that they were considering in putting together those outlooks, and ultimately explaining why the forecasts were off, why the misses were so large. Obviously, like every other forecaster, we missed the magnitude and persistence of the inflation surge. Unanticipated supply-demand imbalances were the main driver of this. The shocks to supply were unexpectedly persistent, or new shocks kept happening. Not a whole lot to do about that part. And of course, the recovery in demand was unexpectedly rapid and unbalanced across sectors. And that sectoral story, of course, is very important, which we've heard already. In the future, there were some suggestions for how forecasting inflation could benefit from alternative measures of slack and taking more seriously the role for nonlinearities. That's hard to do, though, because this was a pretty unique episode that we've been through. I do think we've learned something about the inflation process through it, but no guarantee that these ex post explanations for things that happened would be super useful in projecting inflation going forward, but a fair amount of humility in that statement. Another memo really took an ex post view of looking at the key drivers of inflation over the past 5 years rather than a forecasting perspective, as in the previous memo. And again, the lessons are similar to the broader literature of persistent imbalances between supply and demand across the different sectors of the US economy. So no great surprise there. I think the results are very similar to other analysis in many respects, and what we've heard from the ECB. Probably a smaller role here for energy prices, given less exposure to the Russia's invasion of Ukraine, but similar dynamics. And then, of course, a key focus of this memo was also on inflation expectations, describing how short-term inflation expectations moved along with inflation during 2021 and 2022. They may have also fostered some persistence in the inflation process as well through the labor market, through wage demands and so forth. But through this period, longer-term inflation expectations remained well anchored, which of course was of great benefit and helped contain inflation and allow it to come back down without a large increase in unemployment. And finally, I'll touch on, or briefly touch on this memo, which brought together some lessons from the international experience doing a cross-country comparison. Here, some of the key takeaways were that and as is well known, the inflation experience across countries was really quite similar. And that really points to global factors that are driving the results, that including the demand and supply imbalances I've referred to. Also, strong support from fiscal and monetary policy, of course, played a role. And of course, fiscal was particularly strong in the United States. Similar outcomes for short-term and longer-term inflation expectations. So really a global event. And one point of that is that, different idiosyncratic factors and different policy responses, they mattered, but they played a less critical role than this broader story. And that's true with different monetary policy frameworks as well. And then the final paper tried to link the inflation dynamics to monetary policy strategies. And again, it focused very directly on one of the elements that was introduced into the 2020 consensus statement, which was a form of flexible average inflation targeting, or FATE. And this paper evaluates FATE versus a standard flexible inflation targeting framework in a variety of demand shock settings. And the results are not surprising. They're basically what is consistent with a broad set of literature that led to the adoption of the FATE element of the framework in the first place, which is that FATE can provide better macroeconomic performance than FIT when the ELB risk is significant. But that performance gap is largely eliminated when operating under flexible inflation targeting, if you also use appropriately calibrated explicit forward guidance. I would add QE to that list as well, right? You could make up for some of the shortfall in accommodation through those tools, given the effective lower bound. Of course, if the EL bound is less of a prominent feature of the economic landscape, then the differences between these two strategies is even smaller still. The other thing that comes through in this paper is that the flexible average inflation targeting approach turned out to be fairly complicated to explain. It was actually not operative at all as soon as the inflation surge set in. Then very much the FOMC was operating just with flexible inflation targeting and raising the policy rate aggressively. But it was a complication, and because these mechanisms work through expectations and clear communications and clear understanding on the public, I think there were some lessons to be learned there about the complexity of it as well, which is why that element was removed from the new consensus statement. Okay, last two memos, and then I'll stop. These both focused on uncertainty and risks. The first memo just sort of reviewed the different types of uncertainty about the economy that confront monetary policymakers, very much with a monetary policy view. These are risks about the state of the economy, the structure and dynamics of the economy, and expectations formation and the transmission of policy. The memo also looked at tools that are used to measure or gauge the uncertainty and balance of risks around an outlook. things like fan charts, scenario analysis, statistical models, surveys, and so forth. Each have benefits, each have shortcomings, as we know, and then some discussion about communications about uncertainty and risks. Of course, the main way that the FOMC communicates about this is through a narrative approach, through statements and speeches and press conferences and so forth, though there is a quantitative survey in the SEP that evaluates the policymakers' views of uncertainty and the balance of risks as well. And finally, what does this mean for the conduct of monetary policy? The last memo looked at elements of a robust policy strategy in the face of uncertainty and risks, talks about the robustness of simple rules in some environments, talks about optimal control and certainty equivalence, and when risks are balanced, the baseline outlook is a pretty good guide to policy decisions. And as Christoph mentioned, though, when risks are asymmetric, risk management considerations become very important. Some discussion of alternative scenarios. This has obviously been a very popular topic in central banking circles. They're enormously beneficial for policy deliberations, for thinking about the ways the economy may evolve off baseline and what policy should do in those environments. It's a lot harder to implement as a communication vehicle and requires a lot of complex choices. And so taking a fairly slow and deliberate and careful approach to that on our part. So let me stop there, and I'm happy to address any questions.
Thank you, Trevor, for this very comprehensive overview. Given the international comparison focus of this of today's workshop, it was interesting for me to see several common grounds in the two presentations. For instance, both reviews stressed the importance of acting forcefully, in particular when facing sizable shocks to inflation, to ensure that inflation expectations remain well anchored on the inflation target, but also to build robustness to a wide range of economic conditions. Robustness was also stressed in the reviews by clarifying how monetary policy would react under certain scenarios, for instance, in the event of a significant deflationary or inflationary shock, or when employment and inflation objectives are not complementary. And finally, both reviews highlight that the policy rate remains the main tool, but that additional tool can and should be used when needed. Now, let me perhaps take the advantage of my position to ask the first questions to the presenters. The first one is for Christian or Christoph. If we look ahead, factors such as deglobalization, an aging society, global warming, technological change, and also the high level of government debt will heighten uncertainty about future shocks and about the path of inflation and growth. As you noted in your presentations, a mechanical adjustment to the reaction function may not be advisable because different scenarios may require either attenuation or a more aggressive policy response. So do you see a risk that this context-specific and less predictable approach could increase the volatility in market expectations of inflation, policy rates, and real activity?
Maybe I take the first part of your question and then give the floor also to Christoph. No, I think it's a very interesting question. And what I showed also when I said when I showed this chart on the frequency of price setting, this increase in the frequency of price setting indeed also went along in this period with a steepening of the Phillips curve. And I also would like to stress here that we were able to detect this frequency or this higher repricing mechanism is largely also due that we have developed new data on this frequency of price setting through this Prisma network together with national central banks. So in other words, if we wouldn't have this, let's say, new toolbox or new tools, we would not necessarily be able to detect these things. Now, on the other hand, one also has to say, once we went out of this period of, let's say, high inflation and this high, let's say, frequency of price setting, indeed, the wages also kind of picked up. Then also the steepening of the Phillips curve went back. And actually by the end of 2024, the price setting frequency has normalized again. And also the Phillips curve has flattened again. Now, what does that mean for the future? I think there the interesting thing is to say that that for the future, I mean, the jury is in a way out. And you mentioned these structural drivers. And what we have seen is that they indeed push in different directions. So for the moment, the Phillips curve, the price Phillips curve at least, has sort of come back to where it was and it's relatively flat. But what will happen in the future is, of course, let's say uncertain. And given that we have this uncertainty anyways that is heightened, it's even more tricky to say something about what will happen in the next couple of years, given the geopolitical rifts that we have, and large shocks may come again in the future. Christoph, do you want to say something on monetary policy response?
Yeah, maybe just briefly. I mean, this is a very legitimate question, Fiorella, and a difficult one to answer. I mean, maybe a high-level response is that what I stressed, but also Trevor, is maintaining the credibility to keep inflation expectations anchored. I think that is basically what reduces volatility in the economy. Even if we face severe shocks, and at this stage, it's very hard to predict. You know, structural changes that are slow moving are easier to deal with than if we have an energy price spike of the order of magnitude we saw in 2022, right? And then actually, what is important is that the private sector believes that we're going to bring inflation back to target. Not immediately, that I think also everyone understands, but over a reasonable time horizon. And that's where, in a sense, also this discussion on looking through plays a role. At the end of the day, there are a lot of trade-offs, right? Because you could say, okay, you can increase predictability by pre-committing to particular rate paths. And certainly, if we look back at the last few years, in an environment of high uncertainty, it can prove very costly to enter pre-commitments. And so in that sense, there is a certain reluctance to do so. And so on the other hand, there must be clear communication lines that give orientation. And so one way we've tried to do that is with this stylized reaction function that doesn't tell you exactly what the council will do, but in a sense, what are important pieces of information and analysis that enter decision-making. And behind everything is this unwavering commitment to keep inflation expectations anchored. So also to become very forceful if that's put into question. I think that's the answer. It's very high level, I'm afraid.
Thank you both for your answer. My question to Trevor is that it concerns what you mentioned in your presentation, that the Fed 2020 framework review included this commitment to reassess the strategy, tools, and communication practices every 5 years. Now, regular reviews provide an opportunity to make sure that frameworks remain responsive to new challenges and to an evolving economic environment. At the same time, frequent adjustments to the strategy can also risk being perceived as shortcomings of previous frameworks and potentially weaken public trust. So how do you assess this balance between cost and benefits of regular reviews? And how should the central bank communicate with the public to mitigate the risks associated with it?
Yes, thanks, Sharon. That is a good question indeed. On the one hand, I'm very pleased that we had a review at a 5-year cadence, because I do think the changes that the FOMC made to its consensus statement this time around are ones that will serve the test of time better than the changes that were introduced in 2020. But to your point, there is a balance here. We do, tend to view the FOMC statement on longer run goals and monetary policy strategy as a, so-called quasi-constitutional document. It is not one that is immutable, obviously, but is one that should provide a sound foundation, and over time would change only in response to really new lessons from the economy and what's happening, structural features in the economy. So striking that balance is, of course, important. A key focus of this review, like others, was to make the framework robust to a wide range of economic circumstances. And that was really, I think, a defining principle of this framework review this time, so that it was not over-geared to any particular set of economic circumstances, which arguably the 2020 version of the consensus statement was with regard to the ELB. There's nothing magic about a 5-year cadence. It does seem to be emerging as a norm across central banks. You obviously don't want to do it too frequently, because you don't have time to learn lessons of the deeper forces evolving in the economy, nor do you want to wait too long to make changes. One thing that we discovered before instituting the 5-year review is we did, and the FOMC continues to have, a practice of every January endorsing the consensus statement. But that's really not a very effective vehicle for really thinking deeply and making changes at that frequency. And so the 5-year review is very helpful in that regard. But who's to say how it'll go going forward? The only other thing I would point to on the communication side of this is, there are some things that have not changed throughout this process, have not changed since the initial consensus statement in 2012 under the leadership of Chair Ben Bernanke. And that is, of course, taking as given the mandate given to us by Congress to promote maximum employment and stable prices. And everything in the framework is all constructed to best pursue those two goals, right? And that has not changed. The other thing that has been a common theme, and perhaps is just getting reiterated with greater intensity over time, over subsequent reviews, is the importance of maintaining well-anchored longer-term inflation expectations, as we've already discussed. That was a key element of the 2020. First of all, that was a key element of the original 2012 review by announcing an explicit numerical inflation target of 2%. Again, that has not changed either, the 2% target. And two, it was a key feature of the 2020 review, because the whole purpose of the flexible average inflation targeting element of that was to prevent longer-term inflation expectations from moving too low in those states of the world when inflation had been persistently running below 2%. So that lesson of well-anchored inflation expectations, keeps coming through loud and clear, regardless, and that is, as we've heard, a commonality across central banks.
Thank you very much, Trevor. Ernest, do you see any question in the chat that you want to read out?
Yes. There are two questions in the chat, one from Emmett Ryan, which refers to actually part of the presentations which were given. Is there a consensus that post-COVID spike in inflation in the US is more demand-driven, whereas in the EU it was more supply-driven? And then another question by Marianne Nessen to Trevor. Could you please elaborate on how the employment mandate has changed? What is the role now of maximum employment and so-called shortfalls?
Just quickly on the first question, I don't think we have I'm speaking of the US, I don't think we have a consensus on the relative roles of supply and demand factors in exactly parsing out the inflation surge through the pandemic. There is some illustrative examples of doing that in one of the memos, using the methodology that the San Francisco Fed has developed to try to isolate supply and demand shocks. But it gets very tricky to do that, given the sectoral changes that happened and how a supply shock in one sector can actually look like a demand shock in another sector. It's a very, very difficult thing. I think we're on solid ground when we say that both were a factor. And maybe while I'm talking, I can briefly address the second question, which we'll come to as well, I think, in the next session. And that is, what about shortfalls? So shortfalls, was originally introduced in 2020, really in recognition of the high level of uncertainty about the maximum level of employment, or if we want to put it in unemployment space, about U star, the natural rate of unemployment. And the economic experience leading up to that point, between the global financial crisis and the pandemic, was one in which the labor market continued to be stronger than anyone would have thought ex ante, the unemployment rate moving ever lower, but without any signs whatsoever of pressures on inflation. And so the thing that shortfalls was really meant to engage with is that that is a great outcome for the economy. And monetary policy should not foreclose on the possibility of that happening based on an uncertain estimate of U star. It was not meant, as it has been interpreted, it was not meant to be permanently forswearing a preemptive approach to monetary policy. In fact, other parts of the consensus statement talk about policy being forward-looking. And so I think it turned out to be a confusing way of describing how the committee was thinking about this side of the mandate. The new consensus statement now says that it views maximum employment as the highest level of employment that can be achieved on a sustained basis in a context of price stability. And then to sort of also echo that shortfalls idea that had been there before, the new statement also says, and this is new language, that the committee recognizes that employment may at times run above real-time assessments of maximum employment without necessarily creating risk to price stability. Again, that is not at all a statement about ignoring tightness in the labor market, but it is being mindful of the uncertainty with which we observe the star variables.
Maybe I can also say something on supply and demand, because that was one of the things that we analyzed a lot in our work stream and also debated a lot. And this is why I also think maybe to talk about let's say a consensus is tricky, because what I showed here was indeed these 6 different models, and that I would say that given this analysis, we can say this points in a direction that indeed the supply shocks mattered more, in particular in the beginning, but that doesn't mean that demand shocks were irrelevant. And this we can also see, let's say, in the later phase, in particular of let's say this review period. However, I would also like to say that what is tricky in Europe is, of course, that we look at very different countries. And that was one thing that we debated also in our review, is that for the euro area, we have that evidence, but that doesn't mean that there might be countries that experience a different pattern. So in that sense, this chart that I showed is sort of, let's say, an average analysis for the euro area, but that if whatever individual people or people from certain countries would say, yeah, but in my case, I think it was different, or I have models that show something different, that is a fair view and should be taken also, let's say, into consideration.
Christoph, is there anything you want to add?
I mean, maybe just because that links to the medium term I discussed. At the end of the day, if we face persistent or a series of supply shocks that risk de-anchoring inflation expectations, then in a sense, this sharp distinction that we sometimes see in textbooks, like don't react to supply shocks, but act aggressively on demand shocks, then that distinction gets totally blurred. Then you also have to act in response to supply shocks. And so in that sense, maybe the debate is also, in terms of practical policy making, at least in the latest episode, wasn't so much front and center.
Thank you. And with these lessons that also textbooks learn from practical central banking experience, I thank all the presenters and the audience for the questions, and I pass it to Frank, who will chair the panel. Thank you.
Well, let me also welcome all of you on my behalf. I'm Frank Smets. I'm Deputy Head of the Monetary and Economic Department at the BIS. And of course, it's a great pleasure to moderate this policy panel, which will continue on the same theme and draw some of the implications for monetary policy frameworks of all the analytical work that has been done. And we'll also broaden it beyond the US and Euro area. We have 4 excellent and very knowledgeable panelists. Sharon Kozicki, Deputy Governor of the Bank of Canada. Philip Lane, member of the Executive Board and Chief Economist of the European Central Bank. Hugh Pill, Executive Director for Monetary Analysis and Research of the Bank of England. Unfortunately, John Williams will not be able to join us, but I'm very happy that Trevor agreed to step in and continue this conversation. So the idea is that each of you give some introductory remarks, and then we'll open up for the Q&A. So I'll start with Sharon. Sharon, the floor is yours.
Thanks, Frank. Can everyone hear me? Perfect. It's really a pleasure to be here today, and I'm thankful to the organizers for inviting me to participate. In Canada, we've been inflation targeting since 1991, second only to New Zealand in adopting inflation targeting. And what that means is since 1991, we've got almost 35 years now of experience in fine-tuning our framework, going through a regular 5-year review process that supports framework renewal. So now a few details, because things are actually a little bit different in Canada, and I think it's important to appreciate this. Legally, the preamble to the Bank of Canada Act, it's a little longer, but it basically says to promote the economic and financial welfare of Canadians. So it's not very precise. The precise way we achieve our mandate is set out in an inflation targeting agreement with the Canadian government. And the core elements of this agreement have been essentially the same since 2001 and are really, quite high level. So, for instance, it defines the target measure to be headline CPI inflation. It sets the numerical target for inflation to be the 2% midpoint of 1 to 3% range, and it gives the end date for the current agreement and establishes a 5-year deadline for the next one. So, the agreement, it doesn't just have that one little paragraph. It does tend to provide information on the current economic context and also issues of note. Now, since we renew our framework every 5 years, that of course means we review it every 5 years. And we would argue that these regular reviews are a strength of our system. They give us the opportunity to assess the framework's performance, reflect on what's working well, and consider whether our current approach remains the best for the future. Now, while the broad strokes of the overall framework haven't changed in almost 35 years, that doesn't mean there hasn't been a lot of thought and work that goes into each renewal. And each time we come to a new agreement, a detailed background document that covers the analysis that informed our views is published. So we're constantly, in a sense, fine-tuning things, but it's really more related to our interpretation of what the agreement says. And, I'll get into some of that now. So because the agreement doesn't provide a time frame for sustainably returning inflation to target, we would argue there's also an inherent flexibility in the agreement. So, for example, it opens the door to considering whether there are circumstances when we might want to take more time to return inflation to target. Ahead of each review, we identify the key areas we want to explore. And so typically this amounts to 3 broad questions or groups of questions. These questions generally relate to the framework itself, so what our mandate is, rather than how we set policy to achieve that mandate. So in other words, we're not focusing on the reaction function per se. We're really trying to focus more on the target, the framework itself. So I should say it's not that we don't do any work on the reaction function. Of course, we do a lot of work on the reaction function, but those types of questions are generally examined outside the review process. So our reviews are really about defining the mandate, ensuring that foundation and tools are in place so that we can achieve it, no matter what economic forces transpire. So let me give you some examples. In the past, we've considered whether the level of the inflation target should be lower than 2% or higher. We've also assessed alternative monetary policy frameworks such as price level targeting, nominal GDP targeting, just to give 2. And on occasion, actually I should mention, and dual mandate, explicit dual mandate. And on occasion, we've used our reviews to evaluate issues closely related to the framework, such as how we measure core inflation, or what tools monetary policy could use when the policy rate is at its effective lower bound. Now, I want to note something that we're actually doing a bit differently this time. We typically, as part of the review, look at how inflation targeting has worked for us over the past 5 years. This time, we decided to separate our framework review from this retrospective. And we did this because we wanted to focus on choosing the right framework for the future rather than reviewing our pandemic-related policies. I would say we wanted the public to also focus on the right framework for the future rather than going through a list of issues related to the pandemic. Now, we did do a separate exercise to identify lessons learned from the pandemic experience. Okay, so now that I've made that distinction this time around clear, let me talk to our review process. So it always begins with research. Once we have a broad idea of the questions we want to explore, we turn those over to our research team. They set to work on them. It does not happen in a silo. My colleagues and I on Governing Council interact throughout the process with research staff. Our staff also regularly talk with their counterparts at Canada's Department of Finance. Again, it's an agreement. And that way, both sides make sure they're aware of the analysis underway by either side. We do outreach with the public and other stakeholders, similar to the Fed Listens events, but also some differences. It helps ensure our stakeholders are engaged in the process. In turn, the feedback we get helps to inform our decisions and our communications. The outreach starts early in the process, with our teams talking to experts and academics even to help shape our key questions. Then, as we move closer to renewal, we have what's called community conversations, and these are essentially focused discussions with groups of everyday Canadians. This helps us understand what's on people's minds, where we might have knowledge gaps or other communications challenges. We also do surveys, and we speak with civil society organizations, parliamentarians, and community groups. And as research progresses, our teams go back to the original experts to share preliminary results. We want to hear their opinions and their critical feedback. Now, as analyses roll in, Governing Council discusses whether we found anything that might be sufficiently beneficial to merit changes to our framework. Now, the bar is high because our framework has served us well for many years. We also sometimes give public speeches. This is before we come to our next agreement, because it gives us the opportunity to talk about concepts that could end up being part of our agreement. And again, it just raises awareness to the process that we're going through. All of this eventually feeds into our deliberations among Governing Council members, and then also, of course, to the joint statement that we have with the Department of Finance. Now, once we have that agreement, it's released along with related background documents. We give speeches that delve further into any changes we've made. Often these changes, as I mentioned earlier, are actually an interpretation of the framework rather than its wording. And this comes back to communications. We firmly believe in making sure households, businesses, and financial market participants understand our framework and how it relates to our policy decisions. So let me talk about our current renewal process. We have the current framework is in place until the end of next year, so we don't have a recently announced new framework. So again, first and foremost, we are not revisiting the level of our target. 2% has worked well for us. And as I mentioned earlier, we've spent considerable time and resources debating the level of our target in the past. So instead, we're thinking about monetary policy in a world shaped by trade wars, rising geopolitical tensions, and structural change. And we're looking closely at whether changes to our framework could better prepare us for the next 5 years. Now, our first set of questions are expanding our understanding of the supply side of the economy, and this echoes some of the comments we already heard. Through most of our experience with inflation targeting, we've mainly had to deal with demand side issues. But the pandemic highlighted how supply shocks, supply chain issues, and major structural changes could drive inflationary pressures. And we're now living through a rewiring of global trade. Structural tailwinds such as globalization and favorable demographics are now becoming headwinds. So what does all this mean for monetary policy? Should we look through supply shocks, which is typically means, allowing for more time before inflation ultimately reaches the target? Should we lean against them or even into them? And so, as I mentioned earlier, in terms of flexibility, we have options. Our second set of questions are around how we should measure core inflation, particularly in a world with more supply shocks. We've used various measures of core inflation over the past few decades, and in practice, we often use an even broader range of indicators to assess what we call underlying inflation. So we're taking a close look at what our best approach should be going forward. This is something that my colleague, Deputy Governor Reeve Mendez, is actually going to talk about in a public speech next week. The third set of questions, and this is a little different than some of the other central banks, but it's tied to the interaction between monetary policy, housing costs, and inflation. And again, this is because of some differences vis-a-vis other countries. Housing costs make up almost 30% of the consumer price index in Canada, and that's roughly 7 percentage points each for mortgage interest costs, rent, components related to house prices, and other. And this is really important in the case of Canada because the growth in housing supply has lagged the growth in demand for many years. And this imbalance has contributed to large increases in home prices and therefore large increases in monthly mortgage payments. It's also led to higher rents. And Canadians are very concerned about housing affordability. But the bank cannot resolve Canada's housing shortage. And so, again, the way shelter costs are measured means that changes in our policy rate itself can have direct as well as indirect effects on inflation. When we lower the policy rate, immediately lowers mortgage rates for people with variable rate mortgages. A lower policy also typically leads to lower interest rates for new or newly renegotiated 5-year mortgages. And this reduces inflation coming from mortgage interest costs. But a lower policy rate can boost demand for housing, which eventually leads to increases in home prices. And so this means that this overall means higher inflation in the components tied to housing costs and rent. So clearly it's a very complicated situation, and particularly for our communications. So this time around, we're examining how monetary policy affects the housing sector, what this means for our focus on price stability, keeping in mind that we cannot fix Canada's housing supply issue. So that's what we're currently doing, and I think this is actually a good place to wrap up. So I look forward to your questions and our discussion.
Thank you very much, Sharon. We'll come back to some of those questions and issues. Let me turn to Philip first.
Okay. Good afternoon, everyone. So the review that we finished this year should really be, I think, considered to be a follow-up to the review we published in 2021. As you know, before the 2021 review, there's nearly 20 years since the last review of monetary policy at the ECB, the 2003 review. So there's a very big update in 2021. And we basically committed at that time to assess or reassess whether the 2021 strategy remained fully valid after 5 years of operation. And of course, in those 5 years, the pandemic and the Russia-Ukraine war had a pretty big, information, if you like, for understanding inflation, understanding monetary policy. So what I would say is, in terms of the overall kind of focus of the review this year, was basically to really place at the center how to think about uncertainty. Now, this, of course, is also true for the other reviews, as Trevor said, and the background papers that Trevor went through included, I think, some nice papers there about kind of the what we can handle and the limit to what we can handle in terms of how to incorporate uncertainty. But I think what's important, because it sounds obvious that monetary policy should incorporate uncertainty, But let me emphasize a few points. One, it is in an uncertain world, shocks can happen. So of course, that's always been true for monetary policy. You know, how do you respond to shocks? In that sense, I suppose that we have a two-level answer. One answer was already there in the 2021 review, which is essentially the monetary policy response depends on the origin, magnitude, and persistence of a shock. Now, of course, there's going to be a split between so-called supply shocks and demand shocks in terms of the origin question, and also probably the persistence question, because of course, for at least some types of supply shocks, they might reverse over time. Not just in terms of dying out, but actually reversing in some cases. So for example, the price of oil, we've seen a very big run up. We've also a very big nominal decline in the price of oil. So I think it's self-evident, of course, but it's always been true that the response to a shock does depend on the origin of the shock, the size of the shock, and the persistence. And of course, on the size element, what we saw, you know, in these years was very big, and I think there's been so much work, a really fantastic effort, both within central banks and academia, to inspect the various non-linearities that can kick in when you get large shocks. But I think Trevor said this already in the first part. Of course, the question is how much of that will repeat in the future, and how much is unique to the very specific circumstances we had in these years. And also, maybe importantly, the pandemic really was a unique shock in terms of the relative price shock. So this shock where the relative price of goods to services moved first of all in one direction and then in the other direction. And of course, a sectoral shock to some people, that's a supply shock. To other parts of the economy, it's a demand shock. But where did that bring us? It brought us, as I think Christoph and Christiane emphasized earlier on, to actually, I think, a reasonably straightforward elaboration, if you like, of the 2021 review in the 2025 restatement, which is basically if you have a large sustained deviation of inflation from the target in either direction. So in 21, we were, you know, spelled out the downside deviation, you know, which in turn created lower band issues. But once we lived through it, it's obvious that a lot of considerations also apply in terms of a large upside shock. So this idea that some appropriate combination of forcefulness and persistence are important in dealing with large shocks. So I think that I think is very natural. You want to, you know, we had already in 21 committed to a symmetric interpretation of the 2% target. And that symmetric interpretation means any threat to the anchor, downside risk, upside risk, you want to respond with force and persistence. That doesn't mean an identical response. The lower band does have a different nature to upside shocks. But fundamentally, the symmetric commitment to 2% is behind everything. But let me emphasize, going back to uncertainty, that's one issue. Small shocks, large shocks, what kind of shock? The other element, which I think have emphasized quite a bit at the ECB, is structural change. So essentially, maybe at lower frequency, the world is changing. And of course, sometimes that turns into higher frequency to the extent you can have policy-induced changes in kind of trading relationships. You can have the technical innovations, and we spelled out AI as a particular technical innovation that could be, you know, quite disruptive. And then we have climate change, which at one level with the transition is leading to, you know, a kind of change in the structure of the economy, a change in the energy mix, for example. But of course, it can also lead to volatility in terms of, you know, physical weather shocks and so on. And then we do, you know, what's interesting is this low frequency, highly flagged demographic transition. But we, 5 years later, we're really moving along here in Europe in terms of the visible impact of aging on the nature of the workforce. And I think, as Christiane emphasized earlier on, it does change some of the relationships. So, for example, unemployment in the low 60s in Europe. Historically, I think low 60s in Europe would have said, well, that's pretty tight labor market. And of course, the labor market now is a lot tighter than it was compared to a decade ago. But it's still different. It's still different when your typical worker is maybe 55, not 25. So in terms of, bargaining power in the labor force, mobility, and so on, it is quite different. So the uncertainty is essentially, all of these are structural changes. They tend to be one way. We don't have it, historical data with a very aged workforce, for example. We don't have historical data with a lot of automation and accelerating automation in the economy and so on. So that is a second important element. And then maybe when you put those two together, and a bit like Sharon just mentioned, is you really want, it really raises the stakes in terms of understanding what's going on in the data. So the idea that you want to be data dependent, maybe you say, well, that sounds trivial. And like many things which sound trivial, there's a lot behind it actually. So there's a lot behind saying, look, we are going to take a data-dependent approach to monetary policy. It's basically saying, look, we acknowledge that the foundations of the economy are changing over time. And very quickly from that, you do get to this meeting by meeting philosophy, saying that, you make a decision now. Why pre-commit to the decisions for future meetings when a lot can change in the meantime? So with that kind of, I think, pervasive focal point about uncertainty in diagnosing the economy, in diagnosing inflation dynamics, and again, just in the Bank of Canada case, including essentially a really comprehensive set of underlying inflation indicators, it does mean that we do, I think, have to change communication about monetary policy. And the communication change at the ECB, which we've now got in our monetary policy statement, is a more explicit acknowledgement that our decisions not only reflect the most likely path for the economy, not only the baseline, but also the surrounding risks. Now, again, you might say that's obvious, but it's worthwhile because I think it forces people to pay attention to, okay, because people look at page 1 of our statement where we do give the baseline, and then say, well, okay, with that baseline, I infer X, Y, and Z about monetary policy. But then you said, well, hold on, there's a surrounding risk analysis as well. And we do have this kind of paragraph in the monetary policy statement about the risk assessment, which is a narrative. It's directional. It's not, reduced to some kind of cookie cutter, upside scenario A, downside scenario B. Though, of course, we like these scenarios as well. But maybe we'll come back to this in further rounds, which is basically, it's easy to say, I really mean it, that we need to incorporate uncertainty into decision making. But fundamentally, it creates difficult choices in communication, in what kind of internal analysis to do, and what kind of analysis to share in terms of public communication. I've not given 9 o'clock, Frank, but I think probably that's enough for an opening remarks, and then we can come back to some of that maybe later on.
Thank you very much, Philip. And indeed, I mean, the issue of uncertainty and what it means for monetary policy responses, we will come back to that. Let me give the floor to Hugh. Hi, Hugh.
Hi, Frank, and hello, everyone. And thank you very much for the invitation to participate in this event. Perhaps I could start just by giving some specifics around the UK's review of its own monetary policy framework. in many respects, we're a little bit the mirror image of some of the things that Sharon described, in that we have not had, despite being long-standing inflation targeters over the last 30 years or so, we have not had regular periodic reviews in the manner of the Bank of Canada. We have had a number of episodic reviews which have tended to focus on specific issues and tended in practice to focus on issues surrounding the inflation forecast, because I think a somewhat distinctive feature of the Bank of England's approach to implementing inflation targeting has been both internally within the processes going on inside the bank and externally in its presentation of its analysis and decisions to the public. It's probably put more emphasis on the inflation to forecast, and particularly the famous fan charts for inflation and other macro indicators. And that's really been where some of the previous reviews have focused. Second point I wanted to make, and this goes to our legal framework. I mean, in the language of the academic literature, we are operationally independent at the Bank of England for monetary policy, but we are not target independent. So we do not set our own target. We do not set our mandate in that respect. That is established in the legislation, and the specific inflation target is handed down to the bank by the Treasury on an annual basis in our remit letter. And that remit letter not only describes the target, it defines the target, both in terms of its level and the specific measure of inflation that is used, currently consumer price index, annual consumer price index inflation. But it also sets out a number of issues about the context in which we operate, including how we might set about managing trade-off type situations, as well as the set of instruments that would be available to do that, particularly at the lower bound. So this remit has become quite a long discussion of late, as some of those issues have taken in. The other thing which I think is probably important to talk about well, I should say first that, you know, as a result of the Treasury setting the inflation target, that is something that the Bank of England does not review. So a big part of the reviews that we've heard about, perhaps not so much in the most recent ones, but in previous ones, as has already been discussed by the other central banks represented here, have been reviews of whether we have the appropriate target. And that really isn't something that falls upon the Bank of England to do. That falls elsewhere in the UK authorities. Second point I wanted to make about our institutional framework is the bank has a very strong emphasis on individual accountability of members at the MPC. The Monetary Policy Committee members are expected to vote independently, whether they're internal or external members. And they're expected or required to attend parliamentary hearings where they defend and explain their individual vote, not the vote of the committee as a whole. And I think that does change a little bit the context in which these discussions take place. There's a question about how much the committee should be agreeing on a framework within to operate, and how that interacts with the necessity of allowing individual committee members to take independent views. And I think that's something that's become increasingly challenging in my experience on the MPC over the last 4 years. The forecast used to represent a sort of centripetal force, bringing members of the committee together. But as forecasts have become more difficult to do, and the environment has become more challenging for monetary policy for lots of the reasons that have been discussed earlier in this call, I do think that the forecast has perhaps played a less effective role. And one of the recent announcements by the governor in his Reykjavik speech back in May was that the sort of concept of best collective judgment across the committee as a whole being reflected in the forecast is sort of being watered down at this point. The third thing I would just say about our review, our latest review, and again, this is a little bit distinctive from what I've heard today, is that we had an external review by an external reviewer. He was external to the Bank of England. He wasn't external to the central banking community, because as I'm sure you all know, it was Professor Ben Bernanke, who is sort of unimpeachable reviewer, having chaired the Fed and of course won the Nobel Prize in economics as well. Having an unimpeachable reviewer is quite a challenge. I think it's been a useful one for us in that it's provided a very strong catalyst for thinking. I think the recommendations of Professor Bernanke are hard to deny, and indeed the bank has accepted all 12 of the recommendations he made. But I think the question of whether you have an internal review or an external review is an interesting one for central banks to consider. So let me then turn briefly to where we are in terms of following up on the review. Well, part of the story is that I think the review, correctly in my perspective, revealed and encouraged work on a number of sort of weaknesses in the internal processes of the bank. So monetary policy strategies have both an internal dimension, how you organize yourselves within the building to transform incoming data into policy decisions in the pursuit of your inflation target, and has an external dimension about how you communicate all of that work to the general public, to the markets, to the media, in ways that improve their understanding and reinforce the stability of the formation of long-term inflation expectations. And I think one thing that by nature is inward looking and perhaps therefore less prominent in the sort of discussion of what the Bernanke review has said is that he did point to a number of areas where the Bank of England may have underinvested over recent years and therefore needed to develop new efforts. I think a common one, perhaps, certainly I don't think is unique to us at the bank, but it's certainly a key one at the bank, is on the side of technology. I think Philip mentioned AI and its potential macro effects, but also how to harness that for monetary policy preparation is a key question, but that relies on a whole set of technological infrastructure that we need to build up. And indeed, we need to build it up for more prosaic reasons than just those kind of more modern AI type reasons as well. But perhaps the technological side of this is the sort of most visible and easy to describe. I think there's also identified by Professor Bernanke a set of issues around building up human capital, building up process capital, if you like, organizational capital, and ultimately trying to improve cultural capital within the bank. And I think in the environment that Philip and others have described of uncertainty and challenges for monetary policy, ensuring that you have a culture which promotes internal debate and promotes a rich discussion of issues amongst experts as well as policymakers is something that I think we are working on. And that does seem to be an important element of building up robustness to the challenges that are in place. But as others have said, I think it's also important to reflect on the external part of the strategy. I think it's fair to say that at the Bank of England and on the MPC, we are still working through some of the implications and recommendations of the Bernanke report. Many of the issues we are confronting are ones that others have mentioned, and I'm sure they'll come up in the ensuing discussion. I think we asked Professor Bernanke to give us advice on how to improve our machinery and how to communicate better in an environment of greater uncertainty and an environment of structural change. Both uncertainty and structural change, and maybe the intersection between the two, I think have led our forecast processes to be under challenge. Professor Bernanke demonstrated, and we are undertaking as before, regular forecast evaluations that show the same thing, that our forecasts are no really better or worse than others' forecasts of the UK economy or other forecasts really made by central banks in their own jurisdictions. But overall, through this difficult period, forecasts have become a less reliable guide to the future. And I think one of the lessons we are taking is that we do need to build up a richer risk analysis in the way Philip was just describing, and maybe, as I said, put less weight on the forecast as the single funnel for analysis, both internally and for its presentation externally, and adopt a little bit more of an eclectic view. I think the headline of that in the aftermath of the Bernanke review has been this focus on scenarios. And we are certainly, and have done in the past, and will continue to do scenarios. I think relative to others, what others have said so far, maybe we're more interested in publishing those scenarios to perhaps give a sense of the answer that the MPC forms at some time to these what if questions that I think Christoph was talking about earlier on, with the intention of making clearer what the reaction function of the MPC would be or could be in certain circumstances. I think at the same time, though, that needs to be seen as one part, not the whole part, of a more eclectic approach, which involves spending more time than perhaps in the past looking at the data flow, spending more time than in the past looking at survey indicators, spending more time than in the past looking at financial market indicators, all of which have been things that do not necessarily easily get incorporated into the type of conditional inflation forecasts that have previously been at the center of the bank's analysis, but nonetheless, I think have proved, as various bits of what we've heard this afternoon have demonstrated, very important elements in improving our understanding in real time of some of these structural and other challenges that monetary policy is facing. I do think it's important to emphasize that the Bank of England and MPC's response to the Bernanke review is one that is characterized as kind of an ongoing process. I think one of the key things that we want to do is hardwire into our systems, both the technological systems, but also the process systems, a way of kind of continually reviewing what we are doing. I think the Bank of England did get a bit stuck in a rut in its monetary policy preparation. It was doing a good job, which worked well in relatively benign circumstances. But as those circumstances became more challenging, I think it didn't move quickly enough to adjust to that. And building up the capacity, and that ultimately I think is a human and cultural capacity to respond to changes in a more prompt and richer way, I think that is really lying at the heart of what the big picture response will be. And that by necessity is both a continuous process and a long-term process. So I think it would probably be wrong to say there will be a moment anytime soon where we can say, yes, we have completely implemented the Bernanke report. I think we will always be implementing the Bernanke report, and that shows some of the depth of what we were told to do. So let me stop there and hand back to you, Frank.
Thank you, Hugh. So a lot of work to be done. Trevor, back to you.
Thank you. Yeah, so I thought for my remarks for this panel discussion, I would briefly touch on the highlights of how the FOMC revised its statement on longer run goals and monetary policy strategy, drawing on some of the discussions earlier. The statement, I'll call it the consensus statement, it only has 7 paragraphs. And so I'm very briefly just going to kind of go through top to bottom and highlight the key changes. And things that did not change, importantly, including paragraph 1. Which has been in the statement since the beginning in 2012, and it's really affirming the FOMC's commitment to its goals from statutory goals from the Congress of promoting maximum employment, stable prices, and moderate long-term interest rates. It also talks about the importance of explaining policy decisions from the perspective of informing the public, making monetary policy more effective, and making the central bank more transparent and accountable. A key change appears in paragraph 2. And, you know, continuing the themes of what we've been talking about before, the new paragraph 2 starts with a sentence that is new, that the policy strategy is designed to promote its goal, the committee's goals, maximum employment and stable prices, across a broad range of economic conditions. And so this is really trying to get at this robustness element of the framework. And that paragraph previously had some changes that were introduced in 2020 that really pointed to this central focus of the ELB as a risk to monetary policy, as a risk to the economy. There were three sentences in that paragraph that talked about essentially about R star being low and the downward risks that that imparts upon employment and inflation. Those sentences no longer are in the statement. So the ELB is no longer pointed to kind of as the central conditioning case for the overall statement. But the ELB is not forgotten. The last sentence of the paragraph notes that the committee is prepared to use its full range of tools to achieve its maximum employment and price stability goals, particularly if the federal funds rate is constrained by its effective lower bound. So not at all the case that the ELB is a remnant of the past. It could well be upon us in the future. It certainly was, the policy rate was at the ELB for 7 long years after the global financial crisis. And when the committee made its changes to its statement in 2020, it was again back at the ELB. Who knows what will happen in the future? But as a base case and in the spirit of making the framework document more robust, that particular focus and the elements that come later that were really driven by it have been removed or eased. Paragraph 3, we've talked about a bit before. It explains that the committee views maximum employment as the highest level of employment that can be achieved on a sustained basis in a context of price stability. It also notes that durably achieving maximum employment fosters broad-based economic opportunities and benefits for all Americans. And this is really trying to explain, and I think a little more, using a few more words, what previously had been indicated by the use of calling maximum employment a broad-based and inclusive goal. Those words were not always helpful in describing what the committee was trying to do or not trying to do in terms of its employment mandate. And I think the new language is a much more broad statement about the importance of a strong labor market. And again, that's a lesson that on the one hand is obvious, but on the other, we've heard through our Fed Listens engagements as well, both in 2020 and in 2025. The other big change in that paragraph, which I talked about a little bit earlier, was removing the reference to shortfalls of employment. And I'll come back to that again in a couple of paragraphs. But the idea, again, was that shortfalls was not always interpreted as intended. It was not meant to be a forswearing of preemptive action if the labor market gets tight. It was really meant more as recognition that the maximum level of employment is uncertain and can change over time. And that, of course, is a theme that the consensus statement has always had in it and continues to reiterate. Paragraph 4 is about the inflation side of the mandate. And it begins also with the broad statement about the importance of price stability. It says that price stability is essential for a sound and stable economy and supports the well-being of all Americans. Again, very much echoing lessons from the Fed Listens engagements, also just cognizant of the very difficult experience that many households and businesses faced confronting the high rates of inflation that we saw in 2021, 22 in particular. And also echoing the importance of well-anchored inflation expectations. As I discussed earlier, the flexible average inflation targeting component of the strategy, or the makeup strategy, which would call for a modest overshoot of inflation from the 2% target after periods in which inflation had been running persistently below 2%, that has been removed. So you can think of the statement as now reverting to more standard flexible inflation targeting in all states of the world, not even when inflation has been low. And of course, it always was the case if inflation were not. A new sentence is added to the end of the 4th paragraph, stating that the committee is prepared to act forcefully to ensure that longer-term inflation expectations remain well anchored. My own interpretation of that is that it operates in both directions and is a useful guide to create macroeconomic stability, and is important on both sides of the mandate, not just price stability, but also for employment. Paragraph 5 had a minor change just to eliminate the reference to shortfalls. Paragraph 6 had to do that as well. But the only remaining substantive change I'll point out does occur in paragraph 6. I guess there are a couple here. One is the statement brought back the language stating that the committee follows a, quote, balanced approach in promoting its 2 goals in those circumstances in which the 2 goals are not complementary or in conflict with one another, which arguably they are right now. And in so doing, the FOMC takes into account the extent of departures from its goals and the potentially different time horizons over which employment and inflation are projected to return to its goals. That has always been a guiding principle for the Federal Reserve, given the dual mandate. The main reason that the phrase balanced approach was omitted in 2020 was because it didn't fit very well with the idea of shortfalls. But now shortfalls is gone, and it's now seen to be a useful way, a useful shorthand for characterizing how the committee has been conducting policy. And clearly, through the period of high inflation in recent years, the chair often pointed out that that was the variable that was farthest away from its goal. That was the one policy was focused on, never forgetting the second one, never forgetting employment either, but really gearing the appropriate setting of policy to get both goals back to target, but obviously focusing on the one that's farthest away. And then finally, as I noted, one of the ideas of shortfalls here is repeated, and that is that the committee recognizes that employment may at times run above real-time estimates of maximum employment without necessarily creating risk to price stability. Again, that is not at all about ignoring tightness in the labor market or any inflation pressures that may build from the labor market or any other source, but it is an acknowledgement that on the employment side, we need to be humble about where that maximum employment is. And as defined in the earlier part of the sentence, it is seen as the highest level that could be achieved on a sustainable basis and importantly, in a context of price stability. And finally, the last paragraph is also unchanged from the 2020 edition, and it reiterates the idea that the intention that the committee will conduct a framework review roughly every 5 years. So I'll stop there and happy to take any questions.
Thank you very much, Trevor, and thanks to each of you. So what I suggested, I'll start with sort of a follow-up question to each of you, trying to blend in some of the questions we received on the chat. And so if audience has any other questions, please put them in the chat. Let me start with Sharon. I mean, one of the things that we learned from the inflation surge in 2021, 2022 is that people care about the price level. Now I do remember that the Bank of Canada was one of those central banks that actually actively looked at the issue of price level targeting. And so my question is whether central banks in general should care more about changes in the price level rather than in inflation, because it's sort of perceived by households as affecting their purchasing power. And a second related question, which also came out of some research that Fiorella De Fiore and Damiano Sandri, two colleagues of mine, have found, is that households that actually know what the central bank is, what its mandate is, seem to have less biased short-term inflation expectation. So how important is it actually to reach out to the general public and make sure that they understand what the central bank is about?
Thanks, Frank. So let me start with a little bit on the price levels. So from a theoretical point of view, framework research from some of our past reviews has found that there are some models in which price level targeting would work better than inflation targeting. But that was some models, and these models tend to make assumptions that actually deviate considerably from observed behavior. So the most recent analysis we did on price level targeting was in 2021. And because we did a horse race of a range of different types of strategies, inflation targeting, price level targeting, dual mandate, et cetera. We also at that time, not only the research, but we did broad public and stakeholder consultations. And what they ended up reinforcing was basically that inflation targeting continued to be the best framework for Canada. And then the final thing I'm going to say on this, on the price level issue is, certainly households prefer prices that don't move much, price levels that are on a nice stable trend. But when we think of deviations, large deviations of actual inflation from what that trend level would imply, households aren't actually thinking much of the costs that it could take to bring the price level back to a trend if there had been a sizable overshoot. And in general, it would be very costly if there's been a large deviation on the upside of prices from the trend to bring things back down. And so I think there has been a shift, and we've talked a little bit about this in terms of supply versus demand. Because if we actually look at prior to COVID, the average inflation rate in Canada under our inflation targeting mandate was pretty close to 2%. In other words, what that's saying is prior to COVID, even though we weren't price level targeting, our price level ended up being very close to what a price level targeting strategy would have generated. So this brings us back to looking forward and what's the right strategy for the future. And here, I think it's really important to acknowledge that we're now looking at a world with a lot more structural change, supply side developments. And in that world, I think there are some deeper issues that we would need to investigate on the importance of the price level versus inflation. And so I think, I wouldn't want to go out there, but I think it becomes a more complicated issue to do price level targeting in a world where these more supply side factors could become more dominant, but I don't have the research on that. So the second issue you raised was public outreach. I think public outreach strategy reviews are actually very, very important as part of the public outreach. Again, our reviews do provide a 5-year timing, and on that 5-year timing, we tend to provide more speeches to the public, more consultations. And so we focus a lot of the discussion in our public outreach on strategy on more of that 5-year cycle. So a little less in between. We always talk about the importance of inflation targeting and low, stable, and predictable prices, but more in-depth analysis of the framework we tend to talk about on that 5-year cycle. When we're doing these consultations, they're very broad, right? They're academics, business community, but also civil society, even Indigenous community, which is very important for Canada. So outside of our framework reviews, our outreach tend to have a different focus because they're a little bit more on economic issues of concern. Although when we do outreach to student groups, it's clearly a little bit more what's the bank about, and that would have a little bit more of a touch on framework, but not on review of framework. So I think it is interesting to ask that hypothetical, because we do this focus on a 5-year basis right now where we're really trying to increase understanding of what the bank's mandate is, of what that means, help people understand it, because exactly as you say, when the public understands what our mandate is and how our policy is trying to achieve that mandate, we do tend to have better outcomes. We do tend to have better awareness in terms of the drivers of inflation and better appreciation actually for our actions. The hypothetical though is, what if we didn't have the regular review? I would claim that we wouldn't talk necessarily less about the importance of the framework. I would say it would just be a different type of strategy where it would be part of an ongoing communication strategy in terms of regularly talking about the framework, making it, giving more speeches that are, again, what is our mandate? How do we attempt to achieve it? And helping people understand. The last thing I do want to say, because this is, I think, pretty critical to whenever we have public outreach, that letting people know how we use feedback we receive as part of this. And that may at times even mean publishing results of consultations that aren't positive. That is actually really important. It could be, again, current economy as opposed to framework review. And when we're hearing stories, when those stories start to show up in either summaries of deliberations or in speeches, not specifics, but just general things that we're hearing, that really helps engage the public because they know what they're telling us is being heard. And if we don't give a nod back to what we've heard, then there's going to be a lot less interest in people actually communicating with us, sharing knowledge they have, and listening to things that we're talking about.
Thank you very much. Let me then turn to Philip and ask a few more questions about the impact of uncertainty, and also refer to some of the questions in the chat. So one issue is about communication. Obviously, there's a trade-off between, on the one hand, being clear by focusing on your sort of baseline outlook, which has some clear policy implications, versus being cognizant and communicate about the risks, which may undermine some of the clarity of the main message. So how do you play that trade-off, and in what circumstances do you want to put more emphasis on, say, scenarios and alternative paths versus more the baseline path? And this, it's related to one question by Julian Callow, who suggests that even if you don't publish the scenarios that maybe for internal purposes have been, why don't you publish them later on with some lag? To some extent, that's what the Fed does, although the lag is quite long. And the other question that Julian asks is, of course, there's a lot of uncertainty, but in the end, no, we have now a sort of a tariff shock. I mean, how in practice do you actually judge whether that shock, how much it propagates to prices, and whether that shock is temporary or persistent?
Yes, so I think maybe this may be in contrast to I think one of the point made by Hugh is, I think under uncertainty, the baseline has never been more important. And I think what, from my experience, the world outside, the ECB watchers really want to know, okay, in the end, what do the Eurosystem staff, when they see all of this uncertainty, what goes into the baseline? So the baseline view, I think, is really important under uncertainty. And actually, because typically when you construct scenarios, it's all expressed as deviations from baseline. So in other words, I think it's really, really the most important thing to do is to get a good baseline. And so I don't view it as a kind of contest or a trade-off, in the sense of that, having these scenarios dilutes the baseline. So this may be just a heuristic statement, but I do think the baseline is never more important than under conditions of high uncertainty. Now, the baseline may be a poor guide, but what's important is the best guide, single best guide. So maybe if we had loads of time, we could have a proper discussion about that point. So number one is, I think the world is hungers for that baseline assessment. And then after that, what I think is important is when we have something novel. So this year, or going back even to last year, exactly how to model the change in the global trade policy was novel. So publishing, okay, here are the scenarios. When we look at the different ways to do the decisions, because you do have to make decisions in doing that. Here's, and we did publish, here's reasonable alternatives to the baseline. The same was true with the pandemic, which I think was done very well. And as Christiane mentioned, also Russia-Ukraine war, there were choices to be made. So every so often, when you have a very crystal clear kind of concrete puzzle, showing your homework, not just the baseline, but also the alternatives, I do think is important. But I think after that, maybe going back to, I think, what some, I think Hugh had and some others, it is really what I would like the outside world to focus on is, we have this narrative or qualitative risk assessment, and they do need to work out, okay, what, quantitatively, what does that mean for the ECB if those risks materialize? So, I do want the outside world to have kind of maximum understanding of the models we use to kind of simulate policy. So Christiane earlier on in the presentation showed a whole range of different rate paths. I think maybe Christoph as well. in relation to, okay, here are different ways to handle different kind of possibilities. So I think if we spell out, number one, here are the risks. If we spell out, here are the models, and we publish more and more the underlying models we're using, people can work out not so much what the Governing Council might think, but in terms of what the staff advising the Governing Council might generate in terms of a rate path in relation to any contingency. So that level of cause and effect between different risks, and then, if you like, rate paths, I think is desirable. But with, and here the answer could be different between smaller monetary policy committees and the size of the Governing Council, is to say, well, I think we'd really like to hear the Governing Council debate hypotheticals, not just making a decision, but also tracing out their hypothetical response to different scenarios. I'm not so sure that that's a good use of our time. So short of that, at the technical analytical level, understanding how our models work. So the kind of model-based rate path, fine. But in terms of the Governing Council, adding that burden to already difficult decisions, I'm not so sure about that. So let me stop there, but maybe we can come back to it later if there's time.
Yeah, thank you, Philip. Actually, we can continue on this theme. I mean, there are several questions to Hugh in the chat which are kind of related. One is that the MPC de-emphasizing the inflation forecast has removed a powerful policy signal for markets. Does the Bank of England need to replace this? And what are the options? So this is, again, about this sort of trade-off. Another question is to Hugh is, when will it be possible to know economic forecasts are once again reasonably reliable? Now, given all our emphasis on uncertainty, I'm not sure this is very soon, but as Philip said, at the same time, you need to make a judgment about what is the most likely outcome. And a third one is, from a communication point of view, do you see scenarios as accommodating different reaction functions, as you emphasized, Hugh, or are these different judgments about economic outcomes? This is a lot, but it's around the same set of issues.
So I think I'd start by saying, in response, clearly, as Philip and others have said, I mean, we want to be transparent, we want to be clear, we want to be honest, and we want to be as straightforward as we can be about how we assess the state of the economy, what's its implications for inflation are into the future, and how monetary policy is going to respond to the state of the economy in order to stabilize inflation and inflation expectations in line with target. So I think that, as a statement of what we're trying to achieve, probably everyone on this call could subscribe to. I think it is important to recognize that the starting point, say from 5 years ago at the Bank of England, was a lot of emphasis on a particular forecast of a conditional form expressed via a fan chart and so forth. So that model of using that fan chart to be a summary, if not sufficient statistic for sending messages that are both rationalizing where policy is and offering a guide to where it's headed, I think that ran into challenges in the context of the structural changes, uncertainties, pandemic, Brexit, invasion, and so forth that have been discussed. So I think the challenge is, and here I think probably I agree with Philip, the challenge is to try and generate the best analysis that you can, generate that analysis in a way that gives a rich view of how you view the economy, recognize that part of that rich view of how you view the economy includes the uncertainties surrounding that view. So it's not just the first moment, it's higher moments. And perhaps recognize that that can't easily be done in a challenging environment within a sort of single analytical framework leading to a single fan chart that is easily understood. So the question is the previous machinery is it being as clear and transparent about what the assessment that the governing council is being presented with, as was the case in the past. And I think the answer to that question is probably no. And that is the challenge, is how to replace that framework with something that allows for the more eclectic views, the more risk-based assessments, and in particular how those feed through, as I think Christoph discussed earlier, how those feed through into the policy decisions. And I think that's where scenarios can play some part. I don't think they're the whole answer. In answer to your specific question about how they should be used, I think scenarios can be used in different ways. I think thus far, scenarios have really been used to present, here is how the economy would look differently if we were to see different shocks to the economy or different interpretations of how the economy is operating, and then drawing from those what the implications for monetary policy could be. I think you could, certainly find valuable in other occasions using scenarios where you say, if policy were to be different from what is priced by markets or is in the baseline of a forecast, and at the moment those are the same things, but they needn't necessarily be the same things, at least at the Bank of England. If policy to be different, how would the economy evolve differently from under the situation in the baseline? So I think what's important, and I think this is where the MPC's current focus is to try and develop, and this is where the challenge of having 9 individually accountable members trying to speak, at least on some dimensions, with a common voice becomes significant. But can we come up with a way of emphasizing common messages that are driving the actual decisions of the committee, and then use, whether it's the baseline or scenarios of different forms or other types of analysis, to explain, validate, and justify that decision and guidance. So that's the sense in which I think it's not really a departure. I think we will always produce a forecast. The forecast will always be important. The baseline and the forecast will be at the heart of that. But I think it's recognizing that a more eclectic, a more diverse approach to policy, which perhaps is more complicated, but nonetheless provides greater robustness, precisely because it's entertaining the implications of some of the uncertainties and risks that we face, which I think, whether it's because of risk management concerns or robust control concerns or concerns about the effective lower bound or concerns about the potential for shifts in longer term inflation expectations, and those are not mutually exclusive buckets, but it's having to deal with those type of issues, as I think the experience of recent years has demonstrated we must, in order to identify the cases where that vigorous response that Trevor described is necessary. I think you do need to have a sort of richer set of assessments. And I think that leads to probably where we would like to head, which is to perhaps develop more of a simple view, perhaps a simplistic view, not just of the state of the economy, but how, on a sustained basis, the committee is likely to respond to that, a sort of committee reaction function, which, even if we're adopting a data-dependent meeting-to-meeting approach, there are some lasting principles around which the committee organizes itself. And I think the consensus note that Trevor has helped us through, I think that's a good inspiration for what the MPC might look towards.
Thank you, Hugh. Let me then turn to Trevor. I mean, you mentioned the importance of the low R* environment in the previous review. And there is a question in the chat about where R* is now. We talked a lot about the many structural changes. They all have an impact, or likely to have an impact, on long-term growth, on investment savings imbalances, and thus R*. So, I mean, how do we take into account the uncertainty around R*? And do you have any sort of views on where R* is heading?
Well, if I did have strong views, you should discount them heavily, because I firmly believe none of us really knows the level of R*. and certainly never will ex ante for sure. I don't see that as a particular problem, however, in the sense that dealing with, well, first of all, let me say, having a sense of the neutral, I'll call it the neutral rate, is very helpful in conducting policy. It gives you a sense of the direction you're likely to head in the future if things evolve along your baseline view. That is tremendously helpful. But what is not helpful is to be overly wedded to any particular view of what R star is. And that's where I think things can go awry if you're sort of marching toward an estimate of R star for the sake of getting there, rather for the sake of actually achieving your macroeconomic goals that policy is there to promote in the first place. So my own view of uncertainty around R star is it's a difficult challenge, but it's actually not that difficult for monetary policy, as long as policymakers continually assess the data as it comes in, what it implies for the state of the economy, what it implies for the economic outlook and the risks around that outlook, and then adjust accordingly. You may never end up to the point that you thought you would get, but over that whole time period, you are pushing your goals in the direction that they need to go to fulfill your mandate. And I think the experience before the global financial crisis is a great example of this, in which at the time of liftoff from the ELB in December 2015, the median view from the FOMC, as reflected in the SEP, was that the funds rate would get up to 3.5%. Well, of course, it never did. Was that a problem? I mean, never did prior to the pandemic. Was that a problem? No. We had great economic outcomes along that path. You just learned over time that R star was not as high as you might have thought, that U star, uncertainty about U star, equally important to R star, may be lower than you thought, and you adjust. The key is to be observing what's going on in the economy, updating your assessments, and adjusting policy appropriately in regard to that, and doing so in a systematic manner. So I think the uncertainty around it is super interesting. We're always looking for new ways to reduce it, to have more precise estimates. Very tough problem. But in terms of actually conducting policy, it's manageable in my view.
Okay, thank you very much. I mean, there are many other sort of interesting questions in the chat, but I'm afraid time is up. I just want to thank all four of you for a very interesting panel. I'm sure there will be more to discuss in the future. With this, I don't know if Ernest wants to close.
I think Fabian says a few words of closing.
Thank you very much. So on behalf of the organizers, also thank you very much to you, Frank, for moderating the panel. Thank you to the four distinguished panelists, Sharon, Hugh, Philip, and Trevor, especially Trevor, for stepping in at such short notice. For John Williams, and thank you to Christoph, Christiane, and Trevor for the excellent staff presentations. I mean, I think there's been a very useful, fruitful format of the different central banks and staff and policy making in one event. I certainly learned a lot. I think a couple of themes that sort of cut across what you said is that we need frameworks. We need frameworks that are robust across different circumstances. There's a lot of important structural changes going, which we need to account for. It's key to have an important baseline outlook, but it's also important to take into account the risks around that, and the anchoring of inflation expectations is important. So with that, I would thank you all very much again, and we hope to see you again at future events. And is there anything you'd like to add?
No, thank you. Thank you so much. It was great listening to you, and thanks also for the active discussion. Thank you. Bye-bye.
Thank you.